To what extent is this starting to creep in or maybe even dominate investor conversations now, Hugh? The prospect of perhaps change in US politics, where that leaves some of the investment themes that under a Democratic presidency have been talked about a lot by investors. For example, investing alongside the government on green initiatives.
Absolutely. So it's certainly dominating conversations today, but I do not think it should be dominating decision-making. A year is a very long time. A week is a long time in politics, as they say. And so we have a long way to go until November the 5th. Equally, you look back historically, over the past 3 presidential terms, roughly half of the policy commitments that have been laid out in advance of an election have ultimately made it into law. And so I think there's a very important sort of thinking process to be done here in terms of what this could mean ultimately for the fiscal picture in particular, obviously implications for the bond market. But today, I think the right thing to be doing is doing your homework and not taking investment decisions off what you perceive to be a likely outcome in November, because there's just too far to go in terms of what we know about what's going to happen.
A week can certainly be a long time in politics. It can also be an eternity in markets as well. Talk to us about this bond market here. We're seeing a breakout above 420. 431 is how high yields went. There is a concern that if yields go any higher, it could shake the stock market. What is that threshold?
So, I mean, I've been surprised at how resilient the stock market has been to what has been very sharp moves in bond markets over the past few days. I think probably when you take all of the data that we've had in aggregate this week, it actually tells you not so much about the economy, it tells you a lot more about market positioning. It tells you how excited people have become around this notion of immaculate disinflation, where we just see inflation cruising back to target without needing to see any kind of weakness in growth. Net, OK, US CPI yesterday, a little hotter than expected, but still, ultimately, we think this is a cooling economy. It's just cooling that little less quickly. It's going to take some time to get back down to 2%, and I think you have to be very careful here not to get dragged into this sort of polarised debate as to whether this was all just a January effect and can be completely written off, or whether this is signalling the return of rate hikes and a real inflation problem. You pick through the numbers, I think it'll end up being a bit of both, where some of this pressure in shelter will reverse over the coming months. But equally, we see in areas where the labour market is still strong, some still resilient spending in other parts of services, which is just going to need to take that cooler economy and a bit more time to get the Fed more comfortable in thinking about cutting rates.